Today we will be seeing 5 most used and working strategies in intraday trading. These strategies are easy to implement, and most probably would get you profit. Thinking, what are these strategies? Stay tuned to know them. Hi, this is Stocky. Welcome back to my channel. So, let's get started. Here is a list of intraday trading strategies, which I will be explaining one by one. First is moving average crossover strategy. It identifies market trends using moving averages, making it a fundamental approach for novice traders. The moving average crossover strategy utilizes 2 distinct moving averages, a shorter-term exponential moving average, EMA, known as the fast MA, like 9 or 10 periods, and a longer-term EMA, known as the slow MA, typically 21 or 50 periods. This strategy focuses on detecting buy and sell signals by analyzing the crossovers between these 2 moving averages. Let's see an example. Here is a chart for BPCL stock. Here, as you can see, I have marked fast and slow EMA, that is 9 and 21 EMA respectively. The crosses marked indicate the 2 EMAs crossing each other. As you can observe, the first cross indicates that 9 EMA is moving below 21 EMA and market becomes bearish. Whereas, the second cross indicates 9 EMA is tending to move above 21 EMA and hence market becomes bullish. So, this tells us, whenever there is a significantly visible crossover between EMAs, the market mostly tends to reverse its trend. This being a lagging indicator, the candles would signal the cross is late, but works best with other of your strategies. Next is gap and go trading strategy. It capitalizes on stock gaps driven by news, providing a straightforward strategy with moderate risk. The gap and go strategy capitalizes on noticeable price gaps between the previous day's close and the current day's open. Traders employing this approach aim to trade in the direction of the gap, anticipating momentum continuation. The key steps for this include: identify the gap. At market open, assess for bullish, higher opening, or bearish, lower opening, gaps. Confirm the gap. Verify the gap's significance with above-average trading volume for a more reliable setup. Set entry and exit points. Establish entry points just above the high for bullish gaps or below the low for bearish gaps. Set risk management levels with stop-loss and take profit orders. Monitor the trade, watch price movement and volume closely. Adjust stop-loss and take profit levels as needed. Execute the trade. If the price aligns with the gap's direction, execute the trade. Reconsider or exit if the price stalls or reverses, securing a smaller profit or manageable loss. Here is an example chart, where you can see gaps between last day's close and current day's open like almost every day. The chart shown is like 1-hour chart, but you may consider any comfortable higher time frame. Whenever there is some news on that specific stock or in that sector, these gaps occur most probably on that day or in that week anytime. And based on the direction of gap, you can easily go for the profitable move. Well, these gaps are very powerful. Another strategy is breakout trading strategy. It is used to make time-sensitive decisions based on stock price movements, suitable for intermediate traders seeking to navigate market trends. This approach seeks zones or thresholds where a security has struggled to advance, anticipating a breakthrough beyond those points, as the security may persist in that direction. When the price surpasses one of these thresholds, it is termed a breakout. In this example, do you see that yellow line? That is a very strong level, which has acted as support and resistance many times in the past. So, once this level breaks strongly here on the buy side, you can easily go long and wait for a big move with a big profit. You see that? It almost went 100 points up in that week. Next in the list is momentum trading strategy. It acts swiftly on breaking news, requiring quick decisions for short-term holds, making it suitable for traders with some experience. In momentum trading, the approach involves entering a stock as it initiates an upward movement and promptly exiting when a decline begins. The strategy relies on the notion that stock prices often lag behind their actual value for an extended duration, displaying prolonged movements in a specific direction. This trading method seeks to capitalize on ongoing market trends, with traders buying or selling assets exhibiting strong, sustained movement and exiting when signs of a reversal emerge. The goal is to steer clear of assets displaying sideways movement. To execute momentum trading successfully, one must identify the current trend and select stocks with the strongest momentum within that trend. Well, you can consider the same example as the previous one, because it shows momentum here. It breaks multiple resistances continuously and keeps on moving up, and once the market gets exhausted, it starts to fall. It means that it's time to exit and take our profits. Last, but not the least, is the reversal trading strategy. It is a complex strategy for seasoned traders, involving investments against trends, demanding a deep understanding of market pullbacks. A reversal denotes a shift in the direction of a price trend, either from an upward to a downward movement or vice versa. Traders aim to exit positions aligned with the previous trend before a reversal or as it begins. Reversals involve significant price changes, contrasting with minor countermoves called pullbacks or consolidations. Initially, a reversal may resemble a pullback, but it continues to establish a new trend, unlike a pullback, which concludes before the price resumes the initial trend. Here is an example, where you can see, bears have exhausted near that vertical line, and bulls are giving higher and higher candles to take up next. This is nothing but reversal indication. Here, the trick is that, the red candles go on getting shorter and the green ones start getting bigger. That is the time you can say this is the time for you to enter. This was all about the 5 strategies that are simple and work really well. Always remember, these strategies would work best with other indicators or strategies which you might be used to. A combination always works well for better results. Always consider using higher time frames like maybe 30 minutes or 1 hour and so on, whichever suits you. Also, no strategy would work all the time, but might work most of the times. So, keep practicing with them. Okay then. So, that's all guys for today. See you next time with a new topic. Till then, keep trading and keep learning.